Here's something that's going to sound wrong. In 2026, FHA loans are closing at interest rates about 0.25% below conventional. Lower rate, and a lot of those buyers are still paying more every single month than the conventional buyer down the street. So how does that happen? There's a cost buried inside an FHA loan that nobody puts on the rate sheet, because it isn't on the rate sheet. It's hidden inside the loan balance, where you will never think to look for it. And I'm going to show you exactly where it is. 2 buyers, one $400,000 house, same week, and the real math. Now I'm going to tell you right up front, this one gets into the weeds. I'm not apologizing for that. Save this video. Watch it twice if you need to. This is a 30-year decision made in 20 minutes. So let's set this up. $400,000 house. Buyer A goes FHA. 3.5% down, that's $14,000. Base loan amount, $386,000. Buyer B goes conventional with 5% down. Same house, same week, same lender. Now buyer A has the lower rate. Everybody in that room is telling him FHA is the cheaper loan. His loan officer says it. His agent says it. And here's where it starts to fall apart. FHA charges an upfront mortgage insurance premium of 1.75%. On this loan, that is $6,755, and almost nobody writes a check for it. It gets financed. So his actual starting balance is $392,755. Then, on top of that, annual mortgage insurance at 0.55%, $2,123 a year, about $177 a month. So the question becomes, he got the better rate, so why is his payment the bigger one? And where exactly did that $6,755 go? 3 things decide this. Nobody explains the third one. Now, before we get into the math, there is one genuinely new thing for 2026, and it is good news. Mortgage insurance used to be tax deductible. Then it expired after tax year 2021, gone for 2022, 23, 24, and 25. 4 years, nothing. Well, the One Big Beautiful Bill Act was signed on July 4th of 2025, and it brought that deduction back permanently for premiums paid on or after January 1st, 2026. It's treated as deductible qualified residence interest on Schedule A, and it covers both programs, conventional PMI, FHA mortgage insurance, both the upfront and the annual, the VA funding fee, the USDA guarantee fee. Historically, this thing was claimed 44 million times. About 4 million homeowners a year, $65 billion combined. Average deduction around $2,364. Now here's the catch, and this is where a lot of content on this topic is lying to you by leaving it out. Itemizers only. If you take the standard deduction, this is worth 0 to you. It has to be acquisition debt. And the income phase-out starts at $100,000 of adjusted gross income, dropping 10% for every $1,000 above that, fully gone somewhere in the $109,000 to $110,000 range. So look at what that actually does. The deduction is worth more in real dollars to FHA borrowers because FHA premiums are bigger. And it's least available to the higher earners who were leaning conventional anyway. It softens FHA's disadvantage. It does not erase it. And here's something you can do today. When the deduction lapsed, a lot of servicers stopped populating Box 5 on your Form 1098. Call your servicer. Confirm they're populating it for all of 2026. If they won't commit, keep every monthly statement. So let's get into the mechanisms, because there are only 3, and once you understand them, you can figure out your own situation. Mechanism 1. Conventional loans carry something called loan level price adjustments, LLPAs. What that means is your rate goes up as your credit score goes down and as your loan to value goes up. FHA does not do that. FHA applies no LLPAs at all. FHA pricing is essentially flat across credit tiers. So, say that out loud, because it's the whole thing. FHA charges the 620 borrower and the 780 borrower just about the same rate. Conventional absolutely does not. Now this is an industry figure, not an agency figure, but a borrower at 640 with 5% down can be looking at LLPAs adding 0.5% to 1.5% onto the rate. That is real money every single month. So below about 680, this one lever dominates everything else I'm going to tell you in this video. Mechanism 2, and it runs the other direction. PMI ends. FHA mortgage insurance, if you put under 10% down, does not. On the conventional side, this is statutory. Under the Homeowners Protection Act, you can request cancellation at 80% loan to value, and your servicer has to automatically terminate it at 78%. But listen to this part. Both of those are measured against the original property value, not what your house is worth today. Now there is appreciation-based removal with a new appraisal, but that is your servicer's discretion. That is not a right. Okay, now FHA. Under 10% down, that premium is for the life of the loan. 10% or more down, it terminates automatically at 11 years. That 10% line is the single most consequential number that most FHA borrowers never hear anybody say. On a $300,000 purchase, you're looking at over $50,000 in total mortgage insurance across 30 years if you never refinance. So now you're going to say, fine, I'll just refinance out of it. Hold that thought. I'm coming back to it. So let's go back to our two buyers and answer the question I left hanging. Mechanism 3, that 1.75% upfront premium, almost nobody pays it at closing. It gets financed, rolled into the loan. So buyer A did not pay $6,755. He borrowed it, and he is going to pay interest on it for 30 years. He didn't get a $386,000 loan. He got a $392,755 loan. And that's where the money went. Let me show you what that costs. On a $300,000 purchase, financing an upfront premium of about $5,066 at current rates runs you roughly $12,000 in interest on the premium alone. On the premium, not the house. So here's the finding, and this is really the whole video. At 2026 rates, the total monthly payment including mortgage insurance can come out similar or even slightly lower on conventional, despite FHA having the lower note rate. Because the financed upfront premium inflates the balance, so the rate is not the price. Say that back to yourself before you sit down with a lender. The rate is not the price. There are three separate costs here: your rate, your mortgage insurance, and your loan balance. And this industry advertises exactly one of them. Now I want to be fair because the current pricing is the cheap version. Before March of 2023, annual mortgage insurance on this scenario ran 0.85%. That same buyer would be paying about $273 a month instead of $177. That 30 basis point cut saves him roughly $96 a month, $1,152 a year. So it got better. It did not get cheap. So where's the line? Let me be honest with you first. There is no official cutoff. Nobody at HUD, nobody at FHFA publishes one. What exists is a number that every experienced loan officer in this country will give you, and it's remarkably consistent. Below about 680, FHA usually wins because those LLPAs make conventional expensive at low scores. Above about 680 to 700, conventional usually wins because PMI cancels and FHA mortgage insurance does not. Around 650, that's a genuine toss-up. You model both or you're guessing. 740 and up with 10% down, conventional almost always prices better. On timing, one worked comparison puts 5% down, conventional braking even against FHA, around year 12. That's when PMI drops off. Over 10 years, outcomes across borrower profiles run anywhere from FHA cheaper by $12,000 to conventional cheaper by $47,000. Now, some of you never had a choice, and you need to know that before you shop. 1. The loan limit. In a standard cost county, conventional goes to $832,750. FHA stops at $541,287. That is a $291,000 gap in borrowing capacity. At the high-cost ceiling, they're identical, both at $1.249 million. The gap only exists at the floor, and limits are county by county, so use the HUD lookup tool. 2. Occupancy. FHA is primary residence only. Second home, investment property, that's conventional, full stop. 3. Residency. Since May of 2025, non-permanent residents are ineligible for FHA on every loan type. Conventional has no equivalent bar. 4. Debt to income. FHA's scorecard can tolerate above 50% with compensating factors. Conventional typically caps around 45 to 50. Now, here's a change almost nobody told you about. On April 22nd of 2026, FHFA and HUD jointly announced new credit score models. Fannie and Freddie now accept Vantage Score 4.0. Fannie's selling guide announcement added Vantage Score 4.0 and FICO 10T. HUD announced FHA is adopting both. But here's the part that actually hits you. This is an interim limited rollout. Only approved lenders can deliver Vantage Score evaluated loans. Everybody else is still on Classic FICO with a tri-merge, and a single loan uses one model. They're never blended, never averaged. So think about what that means. Two lenders can pull you in the same week on two different models and quote you two different prices. And neither one is doing anything wrong. There are separate pricing grids being published for these loans. Asked about broader LLPA revisions, Director Polt basically said stay tuned, so connect this back. If your whole FHA versus conventional decision turns on a score in the high 600s, and the score itself now depends on which door you walk through, you have to shop more lenders in 2026 than you did last year. Freddie Mac's own research says one extra quote saves about $600 over the life of the loan. 3 quotes, up to $1,200. Spreads run as wide as 50 basis points on the same program. Now let me correct something. FHA has not cut mortgage insurance premiums in 2026. The March 2023 pricing is still in force. If you've seen a headline or a video saying otherwise, it's wrong. Here's why the confusion exists. FHA's insurance fund capital ratio hit 11.47%. That's more than 5 times the 2% minimum, 11th straight year above it, $188.9 billion in capital. So the lobbying is real. The Mortgage Bankers Association flagged a possible reduction. CHLA says the capital justifies it. NAMB wants a tiered cut. But FHA is also reporting a redefault rate approaching 60% on loss mitigation, which it calls unsustainable. Fund strong. Borrower book is stressed. That's why this isn't automatic. So I told you I'd come back to refinancing out of it. Here it is. There are exactly 4 ways out of FHA mortgage insurance. You hit 11 years, and that only works if you put 10% or more down. You refinance into a conventional loan once you're at 20% equity. You sell. Or you pay the thing off. That's the entire list. Now with 3 to 5% annual appreciation, most borrowers hit 20% equity in 3 to 5 years. Refinance closing costs run $2,000 to $5,000. Common rule of thumb, you refinance if rates drop half a point or if killing that mortgage insurance cuts your payment by $200 or more. So here's the reframe. For a lot of buyers, FHA is not a 30-year product. It's an entry product, and that's fine as long as you bought it knowing that. Most people don't. One warning though, that partial upfront premium refund only exists if you refinance FHA into FHA within 3 years. Go to conventional, and that $6,755 is just gone. Now some levers nobody uses. Seller concessions. FHA is a flat 6% at every loan to value. Conventional is tiered 3, 6, or 9%, depending on the file. So at a low loan to value, conventional might only allow you 3, where FHA still allows 6. On a $300,000 purchase, that's up to $18,000. And what you do with that money matters. Point it at a 2-1 temporary buydown. Rate down 2% year 1, 1% year 2. Way better than burning it on closing costs. And if your income is at or under 80% of area median for that property, look at Home Ready or Home Possible. Reduced PMI pricing. And conventional 97 exists at 3% down, lower than FHA. So no, conventional does not require 20%. I know that was dense. If you're still here, you are already ahead of most buyers walking into a lender's office this month. So 4 things. 1. The rate is not the price. Rate, mortgage insurance, loan balance. Ask for all 3. 2. Ask your loan officer one specific question. Run this both ways and show me total cost at year 5, year 10, and year 30. If they can't or won't, that tells you everything about that loan officer. 3. Shop at least 3 lenders this year. Different credit models, different grids, 50 basis points of spread sitting on the table. And 4. If you go FHA with under 10% down, have an exit plan on day 1. That premium is permanent until you do something about it. Now watch this next video and I'll give you the answer right now. It's locking a rate without ever asking what your loan level price adjustments actually are.